The U.S.-China trade war is going to have a larger impact on growth than Goldman Sachs initially anticipated. The bank lowered its fourth quarter growth forecast by 20 basis points to 1.8%, citing that it no longer expects a trade deal before the 2020 presidential election. Joining us is Ann Berry. She's a partner at Cornell Capital. And great to have you on today.
Thanks.
So, Goldman Sachs has essentially laid out their argument for why they believe that the growth is going to be much slower. I mean, one of them being that there will be no trade deal before the 2020 election. What do you think is, in your view, has actually changed over the last few weeks?
I think they're jumping a little bit on the bandwagon, and sort of conventional wisdom was Trump would be incentivized to try to get a deal done in the run-up to 2020. And I think two things have really changed that perspective. One is the fact that there was a Fed rate cut, which has been subject of a lot of debate. And there is one view out there that has given the White House the confidence to go ahead and press ahead with more aggressive trade moves in anticipation of further Fed cuts to accommodate that in terms of stimulating growth. I think the other piece, too, is the fact that these tariffs are now placed on consumer goods, I think shows that Trump is willing to go after consumer spending, to let that be sort of the sacrificial lamb in a way that hadn't been seen beforehand.
Couldn't you argue, though, the Fed rate cut, I mean, any impact from that has virtually been erased as a result of the president just days later announcing that he's going to move forward on these 10% in tariffs?
Yeah, I think a very good question right now is how much is a Fed rate cut going to continue to impact the economy? How much are you really going to get a stimulus of capital expenditure or business investment, which are two metrics the Goldman report pointed to, when at the same time it's very hard to invest not knowing what your international demand for your product is going to be. So I think you raise a great point. I think it's very unclear.
One of the other unknowns that Goldman points to is just the impact from the uncertainty. When you look at companies and capital investment looking to kind of figure out their plans for the year, I mean, how do you measure that? Because that's the one thing they can't seem to even put a number on.
I think that's a very great question. I think the Fed had the same issue. It's something that everyone can feel and sense, but you really can't analyze it with the degree of specificity that the finance community is used to. I think sentiment's an important one. So I think these surveys of business confidence, whether it's the manufacturing associations, or other sort of niche groups, is important to really understand what CEOs are saying about their investment plans. I think coming into Q3 as well, I think the next earnings season will be critical to see how much capital expenditure, hiring decision-making, and supply chain planning businesses are willing to announce at this point.
When you look at all the safe haven plays, it certainly points to the fears that are accelerating in the market. You look at the yen hitting a 1.5-year high, gold staying above the $1,500 level, and then you've got the bond yields pushing lower as well. There's a big question mark, I think, continues to plague investors, which is there a recession on the horizon? How do you read these most recent moves?
Well, I think the thing that we're used to now is volatility, and I think reading into any specific set of moves at one particular point in time has proven to not be a great predictor of where sentiment will go. I think the market is beginning to wonder, are these indications of a recession? But if you look at the underlying data before the Fed cut and even post the tariff new round, there was very strong underlying economic performance irrespective. So I'm not sure dramatic decisions are going to be made quite yet.
You think there's a bit of an overreaction that's happening?
I think there's probably a slight overreaction, but I think people are just trying to plan for the worst but hope for the best. And one thing that has changed is anticipation of further rate cuts for the rest of the year is new, right? That's definitely popped back up. It's not clear that that's directly tied, though, to a recession, feeling as though it's being imminent.
What's your base case at this point when you look at the Fed? Are we looking at another 25 basis point cut in September, followed by another? You're laughing because obviously we don't know where the Fed is moving, but it strikes me that in the last press conference, Jay Powell was very adamant about saying the trade issue is just a big overhang. We're still trying to figure out where this is all leading.
Well, I think this still trying to figure out piece is the critical point that you just quoted. And I think trying to understand whether there'll be a next rate cut is a little bit of a function of whether we see either the 10% new rate of tariffs on the expanded pool going up, whether that threat seems to be imminent, whether we see how businesses start responding to the 25% bump that came in May and then this new round. So I think the outlook for the Fed for the rest of the year is a little bit of a function of how trade policy moves, frankly, in the next sort of month to 2 months.
And as you look at all of kind of the headwinds that are popping up, what's your biggest concern as you look to year end?
I think there's a couple of different things that interplay. I think continuing to look at the global growth rate. I think one of the things, and the IMF has pointed to this for a long time, when China sneezes, does the rest of the world catch a cold? China has accounted for 20% of annual global growth every year for the last decade. So continuing to watch how that economy continues to perform, I think is a very important indicator for the rest of the year. And then the other piece of this is Europe. Britain, for example, has tipped maybe into maybe not technical recession, but a downturn for the first time since 2008. We'll see how Brexit plays out. So the global landscape's getting more important.
And going back to your point about China, how significant do you think the pain is domestically right now? We know what the narrative coming out of the White House has been all along, that the Chinese are going to hurt more than we do. Essentially, it's become this game of who's going to hurt more. What's your assessment of where the Chinese economy is in terms of how quickly it's deteriorated directly as a result of the trade war?
It's very hard to peel back. The data's hard to peel back. I think there has been obviously some slowdown in consumer spending. I think there's a question around what credit levels are in the Chinese market. But I think it's still a case of wait and see. The one thing that there is still greater coordination in that market than is possible here in the US. And so I think part of the story here will be how that coordination will play out in response to this new tariff round.
And as we look to see what levers China can continue to pull, currency certainly going to be in focus. Are we likely to see the yuan stay above that 7 mark?
No, I think, well, we'll wait and see. But I think for the moment, I think the currency at that level probably stays there for the moment. I think we'll have to see what happens next come September.
Okay, and always good to have you on. And Barry joining me here at the desk.